this discussion that we will start now on FinTechs and bank diversity made me think of a short text I had read from the Finance Innovation Lab in the UK. And they talk about different kinds of innovations, especially when it comes to finance, but not exclusively, saying that there are three types of innovation. There are status quo innovation that are not really changing the relationship between society and the financial industry and banking, but more at increasing its efficiency and the profits of the industry. There's disruptive innovation that would go more into changing the relationship between end users, society, and the industry itself, and would increase transparency, would reduce the number of intermediaries. And there is transformative innovation that would go more at the heart of the system and induce some more fundamental changes in the way finance work. So a lot can be said on how technologies can change the way banking services are being run and provided. And with this third panel, we would like to discuss FinTechs from the perspective of end users, taxpayers, society at large, with at the background this big question of are FinTechs putting us closer to having finance serve society or further away? Most particularly, what will be the contribution of FinTechs to some of the key issues that still need to be tackled in banking? We heard about the too big to fail problem and the interconnectedness and systemic risks that relate to that. The mistrust from end users and mis-selling issues, the pressure on employment, the lack of diversity in banking models. So to talk about all these issues and more and discuss with us in greater details, we have Jakob von Weizsäcker, who is a German MEP. He was elected at the European Parliament in the S&D group in 2014, and he's a member of the Committee on Economic and Monetary Affairs, the Econ Committee. We have Marike van Berkel, who worked in the banking industry for quite some time, more than 70 years, starting then in European affairs for Rabobank Netherlands. She changed then to the European Association of Cooperative Banks in 2001, where she held various roles, up to presently as head of the Department for Retail Banking, Payments and Financial Markets. On my left, Olivier Sales has been an official in the European Commission for more than 20 years, including the last 10 years, if I'm not wrong, at Internal Market and Financial Services. And he was appointed as head of unit for retail financial services and payments in September 2015. And further left, Bruce Davis is the FinTechs representative, a co-founder and joint managing director of Abundance Investment, which was notably the first regulated peer-to-peer investment platform in the world. And he's also a founding member of the UK Association for Crowdfunding. So as a way to introduce the discussion, and before we start digging a bit more in the issue, I'd just like you to give your stance on the issue of FinTech in the context of this discussion in 2-3 sentences, very shortly. And I will first give the microphone to Maaike.
Okay. Thank you to Finance Watch for inviting me here and the ACB in this interesting building. I thought I entered a school first when I saw all the students downstairs, but it is definitely a library and it has a nice atmosphere. As introductory comments, I thought I'd take the question of will the rise of FinTech bring us closer or further away from the objective of making finance serve society? And I'd like to make the statement that perhaps not agreed to by all of you here in the room, that in actual fact banks are still doing quite a lot to finance the real economy. As a representative of cooperative banks, you should know that cooperative banks were created to do exactly that. Cooperative banks were created more than 100 years ago by people in a community putting their savings together and to make those savings transform in investments in, for example, agricultural machinery to be shared by that same community. So, and even though we have evolved from the 100 or so years ago where we were, I think there is still a lot of those same values remaining in the simple traditional banking that many cooperative banks are still doing. We're still close to SMEs, we're still lending in local economies, we're still attached to proximity banking. We still hold on to the thought that banking is also about stakeholder banking and not just shareholder value. And that translates itself in our membership into the fact that maximization of profit is not the objective, but we do need profit to ensure continuity. So we cannot make losses too many times and for too much periods. This is not to say that nothing went wrong and that no cures or no improvements were necessary. I think we have to be honest about that and recognize that some measures were necessary. But I'm also not sure whether FinTech can solve all the problems that are out there. FinTech can do a lot. I think it can improve access to financial services, particularly in terms of ease of use of financial services and bringing together perhaps demand for funding in local communities or in somewhat larger communities via different means. They can also help in analyzing customer data and help the customer in knowing better maybe what he is or isn't prepared to do with his money. But I think on their own, they might not be able to fulfill all the objectives. There's still a need for banks. And what we see for the future is more the model of complementarity, where these traditional banks, let's say, and FinTechs live together, maybe work together, and that the combination of the two should bring better outputs. And perhaps a last note on FinTechs, there is also, of course, the question that FinTechs being still relatively new phenomenon, we need to see a little bit how those new institutions develop, what risks they may carry, and how the regulatory environment will adjust to it.
Yes, thank you very much. It's a pleasure to be here. And perhaps by way of introduction, I briefly want to sketch what I feel are the three most important aspects of FinTech, at least as it presents itself to us today. The first aspect is the infrastructure aspect. There are certain aspects of financial infrastructure that are going to be transformed by FinTech. And in a sense, by really the rollout of the IT revolution in the financial sector, in areas that many customers never really get in touch with directly. For example, clearing and settlement, that's an area that most customers, they wouldn't worry so much what's going on, but that's going to be transformed in one way or another. Perhaps also infrastructures like the infrastructure offered by SWIFT. That's sort of, these are the infrastructure topics. And of course, there are huge opportunities here. There are huge potential cost savings, efficiency gains there. But at the same time, one of the classics of financial regulation is going to loom large. That's the sort of problem of systemic risks and how do you deal with them. And I think there's a second area, which is the area of peer-to-peer, of allowing certain types of disintermediation via the internet, as we've seen it in other internet application areas, and that's very important. And I think there the whole problem of asymmetry of information and the market failures to do with that. And let me just give you one example to illustrate. There was a well-known phenomenon when people started to auction off oil wells in the US. Bidders would basically say, well, I have an estimate of how much oil is in there, how easy is it to get it out, and I do a bid according to that best estimate, or perhaps slightly less than that. And then there emerged a phenomenon called the winner's curse, that people, typically the person who had won had bid too much. Because if you have a sort of random distribution of views on how much it's worth, and it's always going to be sort of the complete outlier at the top getting to win the bid, then chances are they're going to have to pay too much. I mean, these sort of phenomena, and some have to do with consumer protection. There may be other problems related, but I think this whole problem of regulation in situations of important problems of asymmetric information, I think that's the second area. And then the third area, to my mind, is the area, in a sense, of retail finance. And we have a peculiar situation today where, in a sense, Google or Facebook would know better whether somebody is creditworthy than their local bank today. And the issue that's going to loom large is, of course, data protection and how are we going to organize ourselves. And I could very much see sort of in the next decade or so, part of retail banking's representative, the job would be surprising to lobby for data protection, to be champions of data protection, saying, well, we are at least able to provide finance that allows for privacy. Otherwise, in a sense, others who are much better at collecting data might have the competitive edge. So these are three areas, and I'm much looking forward, of course, to the discussion.
Well, of course, you covered already with your introductive words a lot of issues that we will dig into in more details, but I will now leave the floor to Olivier Sales to...
Thank you. Good afternoon all. Happy to be here as well. A few intro words about FinTech, and trying not to repeat what have been said already. For stating the obvious, but this is a massive revolution which is there already, and it's difficult to anticipate all the consequences it will have, both on the markets, for the end users, for the consumers, for the regulators, because it is a complex reality. Like it has been said, there are different types of new providers of FinTech. Some of them are contributing to develop new services. Some of them can be seen as disruptors. That's true. But the reaction of the banking industry is also complex. They are partially threatened on some parts of their business model or their services, but are also accompanying a bit this evolution by being very digital themselves and trying also to foster innovation in their own remits. It poses big challenges also for us regulators, and with Mr. Van Weizsäcker we are representing the regulators in a way. Challenges because there is no easy fix. It's very difficult to craft or imagine some solutions which will apply to all business models, all FinTech, all type of services. There are some massive differences between wholesale securities on one side, retail payments. So there is no easy fix, and there is no rapid fix, because we all know that it takes a couple of years to design, prepare, negotiate, and then implement EU rules. So that's a bit the tension we are confronted with. We are aware of that. But part of the answers come from being very alert on what is happening out there, and we are, from the Commission perspective at least, meaning being quite present in some of those discussions and interacting a lot with banking industry, consumer associations, FinTech themselves. And we have to strike the balance right between regulating when and if it might be necessary, without, on the other hand, stifling innovation. That's the last big challenge, is that if you adopt rules too early, they might be outdated the moment they are advertised in the OJ. So I'm sure we'll come back to some of those issues in the course of the discussion.
Hi there, good afternoon. It's strange, yeah, I suppose I do represent FinTech, except that I don't use the term myself. And I guess it's, from my background, I started out, I was part of the original team that created peer-to-peer lending, and as such, I'm not an economist or a banker. I'm an anthropologist, and the reason why peer-to-peer lending exists is kind of the opposite reason to why we had the banking crisis. So if the banking crisis was a failure of the collective imagination of a lot of very bright people, what we tried to do within peer-to-peer lending was create the conditions whereby you could imagine alternative ways of interacting with something that we all take for granted, specifically money. And what I always find interesting is that in a discussion about fundamentally money, I think I'm the first person to use the term today. So everyone else has used words like finance, capital. The elephant in the room is money. And money is a really difficult concept, and that's why we avoid it, and we try to objectify it by calling it other things. Because that makes it further away from us and perhaps easier to control. But fundamentally, what we're talking about here is, in the case of peer-to-peer, a revolution in the way we think about money and the way we use money. And the disconnect that had occurred way before the crisis, because peer-to-peer lending was created in 2003, was that we saw a massive disconnect between the way that banks imagined money and bankers. And I worked inside banks. I've worked inside all the major UK banks as an anthropologist, observing bankers and their customers in equal measure. There was a disconnect between what they felt was money and what their customers knew to be money or used as money. And a lot of the mis-selling, a lot of the toxic practices as they were known then, and what then became a kind of a complete loss of vision for what banking was supposed to be doing, came about because on the one hand we had one view of money, on the other in society, and on the other there was a sort of rarefied view of money that occurred within banks, to such an extent that it was impossible for them to see what was going wrong, because they weren't looking at the right thing. And I think that, and one of the things I always say to people is, think of money like centimeters. Having more centimeters doesn't make you any taller, which also explains the behavior of a lot of quite short Russian billionaires. That they want more money for what reason? Why do we have money in society? What is use for it? And what FinTech is trying to do is to answer that question in a number of different ways. On the one hand, I think FinTech is looking at the productivity of banks, which has been flat to reverse in a lot of cases, which has made them unable to service a lot of the parts of the economy that they used to be able to service. It's hard to apply across the whole of Europe, and I admit, we've all got very different banking systems, but in the UK, our biggest problem is that it costs so much money for a bank to pick up the phone. One bank quoted me, it cost them £5,000 to pick up the phone to a small business. That's to pick up the phone. It's not even to execute the loan. So it became an exercise in avoiding picking up the phone because it was too expensive. FinTech could be great to introduce new productivity into banking at that point. But I think fundamentally what peer-to-peer lending tried to do, and since then crowdfunding as we've had it in the UK, is to introduce new business models into money. And admittedly, and I've been involved in creating the regulation on crowdfunding in the UK, and also for bringing crowdfunding into our individual savings account, ISA regime. I'm also involved in the discussions around the Capital Markets Union for crowdfunding. I think the fundamental thing there is that we come up, as you said, with principles that allow us to innovate in ways which are in the interests of the customer. So fundamentally what we're there to do is to help people use their money. And if we can come up with ways to do that and establish principles, then the old culture of rules where innovators like me actually work around them, because peer-to-peer lending wasn't regulated, it hadn't been thought of. Then we can act in terms of principles, and you don't have to be a regulator that predicts the future. You can be a regulator that looks to see whether or not people are applying the principles that they're supposed to work by. And I think we've had, good success with that approach so far. And yes, we haven't had a downturn to test it properly. But Zopa's lived through a downturn, the original peer-to-peer lender, and it lived through it pretty well, based on its own set of principles. So I think we're at an early stage in terms of development of FinTech. And I don't think that FinTech will replace banking, but I think it will change our relationship with money, and that may achieve the same thing.
Many thanks for this comprehensive first words. And in fact, we will continue on the topic of diversity in banking. And my next question to you would be, what, to your view, will be the most affected areas of banking activities that will be affected by that, and how will it change, how the emergence of FinTechs will change banks' business model, the diversity in banking? And we could also look at the issue, addressing or not the issue of the too big to fail, because we see indeed a lot of new ideas, FinTechs at small scale, mostly emerging, but will that really feed the diversity we need? Who would like to start on that? We take it from the same order?
Well, before we go into that, I think there is a bit more at stake when it comes to bank business models than FinTech alone. In actual fact, when you talk about traditional banking, FinTech is one impact, but we have low interest rates at the moment, which are, I would say, probably more important for the time being in terms of the business models. There's the overall trend in digitalization and customer behavior accordingly, and new generations growing up with different expectations, different appreciation of what money is, the value of money. Increasing cybersecurity issues, and also attention from the regulator for that particular topic, and supervisory and regulatory attention to that. And then, while I'm talking about perhaps smaller banks, there's the overall regulatory pressure. There is a lack of proportionality, there is direct intervention in prices, there's caps on interchange, there's commission bans that I know Finance Watch is very much in favor, but for smaller banks and distributed, open distribution models, that's not such a good development. So there is more at stake than FinTechs. Now, coming back to your question, where will it hurt most? I think that's very difficult to say, because when it comes to, and I'm just following the three different categories that you just described, which was actually very helpful. In the retail banking area, I think banks are enormously digitalizing themselves. If they don't do it themselves, they partner with FinTechs, or they want to partner with FinTechs, and they will try to partner with FinTechs. When it comes to clearing and settlement, yes, a lot of change is going on. I have the impression the hint was towards distributed ledger technology, which is coming, but, well, we don't see it as yet as an immediate transformator. And if it will transform, then I think banks are probably going to be among the first to take it on. So it will be incorporated into the banking mechanism. And in any case, I feel that when it comes to the securities business, where distributed ledger technology could be made to good use, the functionalities of the different roles that you need in the processing chain of processing securities will remain regulated according to the function. So the underlying technology won't necessarily change that. So there, I also not sure. When it comes to the peer-to-peer lending, I think there could be an impact there where, let's say in communities, there is a large element of dissatisfaction with the way the banking community that is present is servicing the expectations of customers around their money. And I've heard the explanation given about why peer-to-peer lending is coming up. And it reminded me of the reason why cooperative banks grew up at some point. So in local communities, I think if the local bank provides a good service and fulfills the needs, you'll see less peer-to-peer lending. In areas where there is an enormous shortfall of this needs being fulfilled, I think it will grow enormously. But here again, what we also observe among our membership, for example, is that banks position themselves as an intermediator between their own lending, combined with peer-to-peer or crowdfunding, combined perhaps with business angels, etc. So in certain circumstances, SME finance, for example, the bank would take the role as trying to get the total package of financing together, with one part being bank lending, the next part being crowdfunding, and a third part perhaps being a business angel. So also there, I think, yes, there will be an impact, but again, I see a lot of complementarity as well.
If we go back to fundamentals, we can ask ourselves the question: why do we have organizations in the economy like large banks or small banks or different types of organizations of a certain size? And the answer, the best answer, I guess, unfortunately, my sort of discipline, economics, doesn't always have very stable answers. But the best answer that we've been able to come up with is transaction costs. That we say, if it causes too much of a transaction cost to outsource a certain activity, you do it in-house. And now it's obvious that the IT and the FinTech revolution, they changed the nature and the structure of transaction costs. And therefore, they're also going to change, to some extent, the boundaries of the firm, the boundaries of the bank. And that's quite obvious. The sort of make or buy decision, do you do it in-house or do you do somewhere else? They are going to change. And it's going to have a transformative impact. I think banks in 20 years from now, they're going to be rather different organizations from the way that they are today, because of, well, three things really. One thing is technology, that's what we're here to discuss. The second, somewhat related in some instances if it's done well, is regulation. And the third is, of course, to some extent also the question, how do competition regulators look at your organization? And so I think what we need to do, and it's early days, as Olivier has said, it's early days. This is evolving. We don't know yet. I mean, it would be difficult for me as a politician or you as a bureaucrat to second guess what the kind of transaction cost impact on the organization of companies is going to be like at this stage. You're right, it's early days. We just did a report on distributed ledger technology. It's early days. I don't know. I can't tell you, even though I've spent quite a bit of time these last few months, what clearing and settlement is going to look like in 10 years from now. That's why, and I think there's also consensus between us regulators, what we need to do is not wait and see, but we need to wait a little bit because it's too early to tell how we should react, but watch very closely and have the best expertise available to make certain that whenever something really important is changing, we're not sort of 5 years behind and we only wake up when something catastrophic happens, but we're really on top of these developments, which is hard. It's hard for a politician and it's hard for a bureaucrat. That's why we need to bring in the best people. We don't need a stakeholder dialogue. We have them all the time, and that's fine. I have nothing against that. But what we really need in this area is we need to bring the best people on board, and not only to make them available for progress in the private sector, but to make certain that regulators are on top of things.
I would like to add one point to the discussion at this stage, because we talk about activities like payment or structures like payment systems, and but we talk also about lending. And one of the important things maybe to be taken into account is the potential impact of the use of FinTechs on consumers, on society at large. But if we talk about end users, for example, if we have credit scoring taking the lead over quality development that you can find in a relationship, what would that mean for end users? So just adding this this element in the discussion now.
Tell whether someone's going to be a bad debt. So we can at a statistical level, but not at an individual level. And I think that's also a myth at the qualitative level too, okay? So the myth of the bank manager that had his relationships, it's the relationship that regulates whether or not someone pays you back, not what you know about them. And so when we created Zopa, we based it on the only other networked market we could find that wasn't sort of regulated out of sight, which was eBay. And we actually called Zopa eBay for money. And what we noticed about eBay was that it created a perfectly good functioning market with a very few simple rules and trust mechanisms. In other words, we were using social norms to regulate a market, and not hard and fast rules, although there was a police element to it. You know, you could be ejected from the market. And we applied the same rules to Zopa before we had to be regulated and aside in terms of credit risk. But we also then used those to improve the credit models and the credit prediction, the prediction on a statistical level of investment. Because don't forget, when we're talking about peer-to-peer lending, we're not talking about one-to-one relationships. You are talking about one-to-many relationships and many-to-many. And I think what we've got within the financial system at the moment is a number of bottlenecks where those relationships converge to a nexus where you have a very small number of decision makers and a large amount of power and very little accountability. What you have within peer-to-peer lending is, and I often say this, and not everyone in my industry likes it, is 1,000 companies with 1,000 flaws. So we won't all fail for the same reason. You know, we will fail for lots of different reasons, and that makes the whole network more robust, which is I think the lesson from within the sort of Sparkassen network and the approach there, that we don't see ourselves as the next Facebook. We're not looking to dominate the internet or dominate money. We're looking to be an ecosystem. We're realistic about how big you can grow as a financial institution. We don't want to be Citigroup. We don't want to be the Facebook of money. And anyone who sort of sets out with that goal is exactly the same sort of egotist that got us into the mess last time. So what we're looking for here is an ecosystem which is feeds off each other and also competes with each other to provide the best service. I think that's the test in terms of regulation. I think the only thing that's missing, I would say, in terms of regulation, though, against that is we do need some sort of vision about what you want this financial system to do. Politicians are remarkably quiet about that. They talk in very general terms about inflation targets and growth. But what do you actually want it to achieve? What is the purpose of the financial system? Are we there to produce sustainability? Are we there to produce reduce inequality? What are the social outcomes you want? Because if you haven't got a purpose, we'll just go and make money. You need to provide some purpose to the financial system to assess whether it's doing its job. And I think that the good banks have a purpose. The cooperative banks have a broader purpose. And I think this is the test we lack. We lack a sense of what is the broader relevance of this institution in society, and is it performing that role for which we give it certain subsidies. We give it protection, we give it underwriting, we give it a banking, the payment system access and all of that stuff. There's a social license there, which often gets forgotten, and yet that social license is to do with the purpose of the financial institution in the first place. And I think that's where, in regulatory terms, we lost sight of it, and we need to get that back. We need to ask the purpose first before we start asking about rules.
Thank you. Well, there are two questions on which I wanted to react. Briefly on the first one, in the previous round, your question was in which area potentially the FinTech will have the most important impact. Difficult to say from my perspective, because I'm also dealing with payments. I would mention payments, but I think it's fair to stress it. First of all, because there are some huge changes happening now, not only because of changes of regulation, in the sense that indeed the Payment Service Directive will not only bring some new players on the markets. We often mention the competition element in this piece of legislation, but there are other elements, including more safety and security for consumers, more innovation, and more choice potentially for end users. Two, there are some future things to happen in terms of mobile payment, instant payment. There are some standards being developed, and all that will be potentially rolled out in 2018. And indeed, like Marike said, all that fits into the more global setting of digitalization of financial services, and in particular of e-commerce. I was at a conference about e-commerce Monday, and clearly those new ways of payments will have a massive impact, with a potential disruptive effect both on traditional players potentially, but also will present new opportunities for consumers. Moving back to the second question, what are the real challenges from the end user perspective or consumer perspective? There are many. I will maybe mention two. I will be happy to hear other views on that. I think one of the big questions for the end users is the access to information. So in what way and to what type of information the consumer now has access to? Of course, I mean largely via internet. That's something which might need to be looked at, maybe better organized. And we are discussing that with some colleagues, including consumer associations. And the other big thing which relates directly to that is, and Jacob referred to that, is privacy/data protection. More and more through those mobile applications, websites, you are requested to give data about yourself, not only on the social media. So it could bring added value. Maybe you can get better rates for a mortgage or better options for a simple loans product. But it triggers also big questions in the sense that end users potentially don't know exactly what data will be used and what usage of those data some of the service providers will do with that. Maybe they have a bit more certainty with banks, actually, because it's a more traditional model, and contrary to what we often hear, I do believe that individual consumers, they trust the guy or the lady in their local branch. So maybe there is lack of trust in the global banking infrastructure, but at local level and individual level, that's still a big advantage of banks. They have the trust of their consumer. So those two things are critically important. We are looking at them from the regulatory perspective, and on those specific points, the arrival of FinTechs is not changing much. The problematics were there already.
Thank you. I think we touched upon many points. We will not be able to cover them all, but I count on you to ask questions because we will have about 20 minutes for questions from you. But just I would like to go for a last round, asking you, based on the comment that was made by Bruce, which I think was really important about the purpose, but also about building an ecosystem. You said we don't want to be the Facebook of money. Still, if we're talking about infrastructure, probably as the main place for FinTechs to emerge, we would potentially see emerging bigger players. And again, as seen and as mentioned in a report very recently published by the Bank for International Settlement, where they say that these technological arms race can create new winners, losers, and systemic risk in the financial ecosystem, because just we have precisely this bigger players potentially emerging. So my last question to you would be that for a real ecosystem to emerge, we would need to have a genuine regulatory playing field that would allow for the emergence of a genuine diversity. And I would like to hear your take on that issue of the level playing field between banks and FinTechs.
All right, so there's a lot of questions in that question. Perhaps first a general comment about ecosystems and new champions, etc. I think in terms of FinTech or banks, a lot depends on what business model is underlying a bank or a FinTech, and the business model will probably drive the way the FinTech or bank wants to grow. I've heard it said that they don't have the ambition to become universal or a big internet giant. They just want to serve the purpose that they want to serve. And if that's the objective, I think FinTechs are like banks. They will probably try to stay of reasonable size and just big enough to serve the purpose they want to serve, just like banks do that. What doesn't help, though, is on a general level, the regulatory environment for banks, not yet for FinTechs, I think, but for banks, and maybe it will come for FinTechs, is driving everybody to the creation of scale, cost reduction. Cost reduction means you want to partner up. If you push us a bit further and you start insisting on cross-border retail financial services, again, you're driving us to scale. Because you don't all want to be cross-border. You might be happy with what you're serving, but if the cross-border push is there, scale makes sense. Scale means partnering up, buying new technologies or outsourcing to technologies. And I'm not sure we should continue pushing for scale, not even unintentionally. But coming back to the regulatory environment and level playing field, because FinTechs are so diverse in their nature, what I'm going to say does not apply to every kind of FinTech. It is just a general sum up of where we think maybe there is not yet a level playing field. And maybe some of it is based on our experience with PSD2, because it's a very real and recent experience. But here we go. For us, the regulatory framework looking forward needs to be careful to attribute the right responsibilities to the right parties. What we see for the time being is that banks have an enormously heavy duty of care for their clients. I'm not debating that we shouldn't have it, but we have it. Not all FinTechs have the same duty of care. And there is not necessarily level playing field there. I know there is a lot of work going on also in the area of crowdfunding, but for the time being it's a relatively patchy legal framework, different from one country to the other. Also, for some reason, FinTechs can get away with tick the box to agree the terms and conditions, but banks can't. Security against fraud, data breach and cybercrime. I'm not sure that the framework that we have to meet in those contexts, in that context, is already the same for FinTechs. Additional supervisory requirements. We, as banks, are dealing on a day-to-day basis with ESMA and EBA. And they don't only implement level 2 legislation, but they also issue guidelines and opinions. And in the guidelines, what we see sometimes is that they actually do a little top-up of what the regulatory framework has already stipulated. And not all FinTechs are subject to the same authority as we are. So we get the top-ups. The FinTechs, even if they have to apply the same regulation, don't necessarily get the top-ups. We need to put liabilities where they are. That means, and here I'm clearly referring to payments, but maybe there's an example in the future as well. The party that executes a certain function should hold the responsibility and the liability for that function, unless otherwise agreed by contract. In the case of TPPs, we still believe it's not correct that the bank takes all liability, whereas part of the payment chain is not in our hands. And we could solve that by contracting with TPPs, but the PSD has not made that very easy. And forward-looking, I think there should be a principle that should be more carefully looked at. Data ownership. There is a tendency in the UK to open up bank data beyond payments to third parties. I think we need to be very careful about doing so. And when we do it, or if we do it, there is such a thing as data ownership. Yes, we get the data from the client, but by using them and evaluating them, we add value to those data. And the value added to those data, for example, by applying the expertise we have about risk or credit risk or other risk, should not simply be made available to everybody without recognizing the value that has been added. And this, I think, should also become a discussion in the context of platforms. Then the final point I think we'd like to make is that we should be a bit careful making banks take the role of public utilities. And what do I mean by that? When it comes to financial inclusion, the Payment Account Directive only applies to banks. When it comes to closing bank branches or taking away ATMs from communities, yeah, it's painful. We don't do it because we're taking pleasure in doing it. We do it because we need to reduce costs. But somehow, banks are always the ones that are supposed to fulfill that role. And that makes sense from the historical perspective. But maybe from a future-looking perspective, we should take a broader view on these things. Financial sanctions. When there is a country that we no longer like, banks are the first ones to be looked at for making sure that all the funds are frozen. We do that, nobody pays us for it, but we do it. Bank arrestments, if there is a cross-border insolvency case, we are asked to freeze the funds. Again, we do it, we're not necessarily getting paid for it, but we do it. And there's a lot of these public functions that we perform, not noticed. And in an environment, I think, where others are taking similar roles to banks, maybe we should extend the horizon a little bit and not always look to banks for fulfilling certain functions. And a final point, which doesn't have much to do with regulation, but which is more a thing of culture and time, I guess. We also face the fact that when we deal with customer data, it's not so accepted that we might process them or make commercial use out of them, but other parties, it's more easily accepted. This you cannot deal with by regulation, but it's a fact. And this, I think, also provides for a level playing field.
Maybe I will let Bruce continue, and then Olivier Sales and Jacob van Weizsäcker.
Yeah, so in terms of level playing field, we work very hard for that. We've had a few occasions in the UK where access to the banking system hasn't been on equal measures for FinTech players and crowdfunding. And essentially what the UK government has often done is put the key players in a room and banged heads together until that level playing field has been recreated. And that's been quite an effective process. So we didn't need regulation to do that. We just had to remind people of their responsibilities. But I think there's a broader point there around these relationships. So, you know, the impact of FinTech, I think, will be we will see people having more relationships with more financial institutions, and I think that will be a good thing. So in the UK, you're more likely to get divorced than you are to leave your bank, still. And I think now we're seeing people being able to manage, and this comes back to transaction costs, and being able to manage a large number of financial relationships with different providers. Now that raises challenges. Each of those providers will have different regulatory responsibilities. But it isn't impossible for each, in terms of my own business, the only thing I'm not regulated for is taking deposits. And I'm quite glad about that because I don't feel that's necessary. But otherwise, I'm as regulated as a bank. All my other responsibilities around AML and KYC, they're at the same level as a bank, and these systems I'm required to have to be to the same satisfaction and as for the regulator as a bank would have. So it is possible to build that, but to build it for a fraction of the cost. And I think this is where I built a banking system for £60,000, and four people built that. So the technology we're building it from is so transformative that I think we haven't really worked out what that means for banking. I think on that sort of diversity point, it kind of works the other way. It is that you will no longer have this big reliance on a single institution in your life that requires some of these regulatory controls to be there, where you've got this very dominant institution in your life who controls all sorts of your transactions. You'll be able to move between different institutions much more easily. So that will be quite a change. And I think against that is sort of what we found a little bit within sort of, say, the Capital Markets Union is there is still a resistance to the idea that individuals can make their own decisions, for example, moving their money across border or wanting to diversify their investments away from their home country. And a lot of that's to do with the European Monetary Union and pressures on where capital is and imbalances in that system. And I think the final bit there is really, there's a little bit, again, comes back to the idea of money. So we still have an obsession that the money that we have in a bank should be liquid. That in fact is money, effectively. And we're still in the UK and in Europe on emergency measures in terms of the insurance on that liquidity at £75,000. And we haven't gone back to the world we used to be. And that sends a strange signal to people that somehow money has to be liquid, that all of their money should be in some form of cash equivalent deposit. And so what we're seeing is a real pressure then on banks to find ways of investing that short-term money into long-term projects. And I think that's why they're feeling the pain in terms of needing to hold more equity. And I think we had Vickers standing up in Parliament saying he's very worried about the Bank of England's imposition of capital controls. He feels that they're not strong enough. But I think they're not looking at the real problem. The real problem is just how much banks' liabilities need to be insured, and therefore the risk on their equity is so great. And we're kind of creating this imbalance by a kind of paradox of safety, where we're chasing safety and creating a more imbalanced system as a result. And there is no political will at the moment to change that. And I don't, there's a fear of doing anything around that insurance scheme, but it's causing enormous imbalances within banks and enormous imbalances in terms of a level playing field as to what you can offer people for your money. I can't offer liquidity. My investors make 20-year investments into renewable energy. They're liquid in the sense of the secondary market, but they're locked away for 20 years. To sort of educate the whole market that would be a better way to invest your money is a challenge when they can get a £75,000 free insurance policy underwritten by the UK Treasury. It's just a crazy world that we live in at the moment.
Just a short check. We still have about 20 minutes, right? Yes, thank you. So I will let you wrap up and then open to.
Well, so we have to be quick. Well, this discussion about level playing field is a complex one, which we often have with the banking industry in particular. Maybe just two messages on that. And first, to put things back in perspective, including in a historical perspective. Banking industry is often saying that they have been overwhelmed with massive regulation overhaul over the last years, and that's true. And it has a cost and a compliance cost for them, and all that is true. But we have to remember that it came from the financial crisis, so there were some reasons to revamp and restructure a bit financial regulation over the last years, and to put it a bit provocatively, FinTech were not there at the time. So there is partially a reason why there is a big burden of regulation on banking industry. Two, let's not forget that startups or new players, they are largely submitted to existing EU rules. For instance, if they have to establish in another country, they have to respect the rules of establishment. If they decide to provide services, then they will be submitted to the Permanent Service Directive, so they will have to be registered, licensed, and they will be theoretically supervised. And theoretically, the same for banking services. If one startup decides to provide a banking service, they will have to get a banking license. So the reality is a bit more complex. Now, many things that Marike said are correct. One of the challenges is how far the regulators and supervisors will look at those new players. And it's true that there are some issues of tradition, of resources, and that's a challenge we will have to look at. On the future forward-looking dimension, I think some of the key things which are critical here are proportionality. Indeed, we have to see whether some of those rules which apply to banks should expand to new players, but here again it's complex. There is no easy solution and no one size fits all. And the other element, of course, is the risk assessment. I don't want to reopen the too big to fail debate, but some small players, startups, doesn't represent the same risk for financial stability like big banks are doing. So to a certain extent, and it's a challenge for us regulators, we should try to embed a bit of this risk weighting and flexibility in our legislation, which we have not managed to do so far, but which we are ready to look at now, and including via those ideas of proportionality.
Thank you.
Yeah, just very briefly, basically there are two issues. One issue is that since the financial industry and banking in particular, for very good reasons, are extremely regulated industries, this regulation presents huge barriers to entries for newcomers, even if they have new technologies. They're huge barriers to entry. And frankly, it's one of the reasons why FinTech is perhaps going to grow somewhat more slowly than some people think it will, because some of the people coming from the IT industry, they underestimate the extent to which there are enormous regulatory barriers to entry. And I would even go a little bit further. I think there's some banks that they're not really experts in customers, they're not really experts in technology, they're not really experts in anything other than being very, very good at navigating the difficult regulatory environment. That's their competitive edge. That's perhaps a bit of a caricature, but I think there's a grain of truth in that. So that is an issue we have to look at. And of course, there's also the other very well-known issue. We know that issue from the discussion of shadow banking. And that, yes, of course, there's regulatory arbitrage going on. There are people saying, well, let's escape the most heavily regulated area and move somewhere else. And obviously, to the extent that new technologies, FinTech reduces friction, this kind of regulatory arbitrage becomes more of an issue. So they're both issues. There's the issue of how can you have a reduction in barriers to entry where it doesn't make sense. We simply weren't aware as regulators of new technologies, and we regulated in a way that in effect is not technology neutral, and therefore presents huge barriers to entry. And on the other hand, we have the challenge of some of the issues we've known about for a long time, people moving out of the heavily regulated areas for reasons of regulatory arbitrage becoming more of an issue. And we need to deal with both of these issues at the same time, and it's a huge challenge because they go in opposite direction, and some people get confused in the process, but that's something we have to live with.
I will first ask our panelists here if they want to answer the question about how do they see the difference between what happened in the mid-90s and the anticipation of new technologies and what's going on now. Yeah, all of you.
Yeah, so my first-hand experience was working inside Egg Bank. Egg tried to buy a French bank and a German bank. We didn't go to Germany because Egg doesn't mean anything. EGG, what is that? Just killed the market research overnight. But that was the problem. It was a barrier of culture, not a barrier of economics. And in France, they didn't understand what we wanted to try and get them to do with credit cards. So that failed quite badly. And Zopa was created out of that failure. So the person who founded Zopa also founded Egg. And I think what you're getting to there is really what we didn't ask inside Egg was what are we trying to achieve? And because we didn't ask that question, you follow the line of least resistance and become, in that case, a credit card company. And that was the business that you were in the early sort of late 90s, early 2000s, was handing out essentially free cash on a card. And so it's very easy to lose sight of why you're doing something. And I think it comes back to this point around, I think that was the sort of the dot-com bubble was you lose sight of the purpose and you start to follow the technology, you start to follow the bubble. And that's really the definition of a bubble is a lack of realism. And you start to believe the fantasy as real. Now, I don't think we're in that point. We're not in a bubble in that sense here, although if you go to China, I think you'll see a very different idea of what peer-to-peer is. So, you know, we're in different cultures. We're sort of approaching these innovations in different ways, and I think the failure of Egg was a very specifically British kind of failure, and I think it's interesting then how peer-to-peer will then develop in that way.
Thank you. I think Michael, you wanted to add something, or
yeah, for me, I think the question about the difference between technological innovation in the 90s and now is that in the 90s technology wasn't available to everybody. technology and computers were only available to those who had the money to buy mainframes and big computers. And now, you know, an Apple is at the reaches of almost everybody, and an Apple can do more than the mainframes from 30 years ago. So I think technology has become much more available and accessible, and that has led to a lot of new developments, including FinTechs that we see today.
On the first question on huge players, I think you're right. There is a distinct possibility of that happening, and I mentioned that perhaps Google or Facebook today have more information to assess credit risks than your traditional bank or credit card company, and that means quite a lot. And of course, if you have this huge information advantage, there could be a big competition issues. They could come from another way. They could come from technology. For example, we were looking a little bit, if you have automatic contracts on a blockchain, perhaps then you have this sort of a very high barrier to entry. Sort of, if you have lots of stuff on the blockchain, then you want to use the blockchain to the maximum because the transaction costs for your automatic contracts are going to be low. So you have a competition issue there. So there are lots of very interesting competition issues to look at. And I try to link that to the second question on mis-selling. Some people say cross-selling. Basically, you know, if to some extent you own the customer, then you try to sell the customer additional stuff, which may be good for you. It's something that Google does, but not necessarily, and many banks do, because they sell products that give them high fees. And the question is, how do you protect consumers from that sort of situation? And we're not very good at that today. And Italy is a very good example. There were some issues, you know, selling simple savers, junior debt of your bank, is perhaps not the best idea, as we now, I mean, it's come back to haunt us. So I think consumer protection and working out ways in which we can stop the practice of cross-selling and mis-selling and milking your customer to his disadvantage, that's a huge issue, and we need to try and deal with it. Perhaps also with the help of robo-advice, but that also needs to be, of course, regulated.
I will let you continue, as the second question was asked to you directly.
Well, not much to add. I think indeed, to answer our Italian friend, we have to differentiate what are the normal and internal practices within banks, which we don't master. There is no regulation about that. And what are the more structural risk of mis-selling or misconduct? And what Jakub has said is correct. It relates also to information, to the role of advisors. This is partially regulated for at least complex products, via PRIPS, MiFID. But potentially there are some progresses to be made for basic retail products. On the first question, well, the big issue which you all have in mind is that most of the big players we are referring to are not European. So that's one of the big questions. So there are some attempts to try to rebalance that. Some recent proposal from the Commission also on geo-blocking might foster a bit some European champions. But this is a big issue. Now, whether at the end it will be a big FinTech to completely replace all the banks, I don't believe that. And Guillaume, on verra après.
Sure. Yeah. So I agree on. I think the mis-selling really occurs when banks forget that they're not in. You know, we see a bank making a profit on the spread between lending and liabilities, deposits, and the lending on the other side. And when they're not making any money from that, they try and make money from other things like selling insurance. And they've been. You know, we've got the most quantitative easing that we've had in the UK has come from PPI, our payment protection insurance. Mis-selling claims, it's something like 40 billion has got into our economy directly. We talk about helicopter money. We're literally shipping it out in lorries into the real economy to compensate people who bought £3,500 insurance policies without realising it when they took out a loan. So, that's because the banks felt pressure to make money from other than lending money. And I think this is the problem we have. We regulate banks as if they do one thing, and in fact they do a million other things. And that regulation is actually covered by the same regulation I'm covered by, which is treating customers fairly. There are 11 principles of treating customers fairly in the UK. I don't know why it's 11 and not 10. Anyways, there's 11. You follow them, and you don't do stuff like mis-selling PPI. Okay, so it's not difficult. But when you're not making money from your core business, you start doing other things that are a bit strange and weird, and that's when it really costs you money as a bank. But we've given out much more money in terms of PPI claims than we have in any other kind of austerity measure that's been going on in the UK.
I will leave you the final word.
On the topic of giants and big fintechs, I think what Olivier said is true, and I'm only regretting that they've been able to gather all those data before the data protection regulation came in, so now they have them and we don't. So and maybe we should think about an app for banks to access Google data and open up the access of Google data to other service providers than Google alone. But that's a joke aside, half a joke. But I think it's a real issue. On the issue of cross-selling, I mean, from the perspective of cooperative banks, you would be silly to buy something your clients don't want, because your members will walk away, and with your members, your capital walks away because your members contribute to your capital. So there is an element of social control. But beyond that, I think the regulation that has come in on bonuses and wrongful incentives should iron out whatever is left of those wrong incentives still out there.